Becoming a dad completely changes the way you think about money. You're not just investing for yourself anymore. You might be investing for retirement, your child's education, a bigger home, or simply trying to build enough wealth that money becomes one less thing your family has to worry about. But with thousands of investments and financial products out there, where do you even start? Here are 5 types of investments every dad should understand, even if you never end up owning all 5. I'll explain what each one does, the risks, and where it might fit within your family's financial plan. This video is for educational purposes only and shouldn't be considered financial or investment advice. Let's start with probably the most important one, broad market ETFs. If you only learn about one investment from this video, make it this one. An ETF, or an exchange traded fund, is essentially a basket of investments that you can buy and sell like a stock. And broad market ETFs can give you exposure to hundreds or even thousands of companies with a single purchase. Instead of trying to figure out if company X or company Y will be doing well, you can own a piece of a huge part of the market. And there are 2 major reasons I think dads should understand these: diversification and cost. Diversification means your family's long-term wealth isn't dependent on one company succeeding. If you put $10,000 in one individual company and it collapses, it can be devastating. But if that $10,000 is spread across hundreds or thousands of businesses, one company failing has a much smaller impact. The second advantage is cost. Many index ETFs have relatively low management fees because they're designed to track an index rather than paying a team to constantly pick stocks. And fees matter more than people realize. A difference that looks tiny every year can add up to thousands of dollars over decades because that money could otherwise have remained invested and compounded. For a dad investing for retirement 20 or 30 years from now, that matters. But reminder, an ETF is just the container. You still need to understand what's inside it. A Canadian stock ETF, a US stock ETF, a global ETF, a fixed income ETF can all behave very differently. Next is probably the least exciting option on this list, a high interest saving account, or HISA. Technically, a HISA is better thought of as a savings vehicle rather than a traditional investment. But I think every dad should understand where it fits into a family's financial plan. Because not every dollar you have should be trying to maximize returns. Sometimes the priority is simply keeping money safe, accessible, and earning some interest. Think about your family's emergency fund. If you have 3 to 6 months of expenses set aside in case you lose your job, your furnace breaks, or something unexpected happens, you probably don't want that money invested entirely in the stock market. Imagine needing $10,000 during an emergency right after the market drops 30%. You could be forced to sell investments at exactly the wrong time. A HISA can help solve that problem. Your money generally remains accessible while earning interest. And HISAs can also make sense for short-term goals. Maybe you're planning to buy a car next year. Maybe you're saving for a family vacation. Or maybe you're building up money for a down payment. If you know you're going to need that money relatively soon, protecting the money you've already saved may be more important than trying to squeeze out a higher return. But HISAs have a major downside. They're generally not designed for long-term wealth creation. If you're investing for something 20 or 30 years away, keeping everything in cash can create another risk: inflation. If your money doesn't grow fast enough to keep up with rising prices, its purchasing power can decline over time. So I wouldn't look at a HISA as a replacement for long-term investing. I'd look at it as another tool in your financial toolbox. And as a dad, one of the most important things you can learn is matching the tool to the goal. Money you might need tomorrow should be treated very differently from money you won't need for 25 years. Now let's talk about something extremely Canadian. The Guaranteed Investment Certificate, or a GIC, which is basically an agreement with a financial institution. You deposit your money for a specified period, and in exchange, you receive an agreed rate of return. And unlike stocks, you're not sitting there watching the value move up and down every day. GICs can be useful for money where capital preservation matters more than growth. Let's say your family has $30,000 saved for something you expect to buy in 2 years. Maybe it's a renovation, maybe it's a car. A GIC can give you more certainty, but there's a trade-off. Over longer periods, GICs don't provide the same growth as equities. GICs are generally about certainty and capital preservation. As a dad, you need to know when each objective matters more. Now we get into the investment everyone loves talking about: individual stocks. Buying a stock means buying an ownership interest in a company. And yes, picking the right company can generate incredible returns. The problem is that picking the wrong company can do the exact opposite. There's something I think every dad should remember. A great company isn't automatically a great investment at any price. You could correctly identify a fantastic business and lose money if you dramatically overpay for it. When you buy individual stocks, you should understand things like, what does this company actually do? How does it make money? Is it profitable now and in the long term? How much debt does it have? What are the competitive advantages? And most importantly, why do I believe this investment is worth the price I'm paying today? Buying a stock because somebody on social media says it's going to the moon isn't investing. That's speculation. And there's another risk here that's especially important when you're investing for your family, and that's concentration. If you have half of your family's investment portfolio tied to one company, one bad earnings report or one scandal or one technological disruption or bankruptcy could seriously damage your wealth. That doesn't mean dads should never own individual stocks, but understand the difference between having individual stocks as one part of a diversified strategy and betting your family's financial future on 3 companies. Those are very different things. And finally, we have real estate. For many Canadian families, real estate is actually the largest asset they'll ever own. Your primary residence itself can be part of your net worth, but investment real estate is different. Maybe you're thinking about buying a rental condo or another property that generates rental income. Real estate has some attractive characteristics. You can potentially receive rental income, the property may appreciate over time, and unlike buying stocks, real estate can allow you to use significant leverage. For example, you might control a $500,000 property without putting $500,000 of your own money. But leverage works both ways. If your property increases in value, leverage can amplify your return. But if it falls in value, leverage can amplify your losses. And being a landlord also comes with costs people sometimes underestimate. Property taxes, insurance, repairs, maintenance, condo fees, vacancies, and the potential of bad tenants. That's why you should never judge a rental property simply by saying the rent is $2,500 and my mortgage is $2,200, so I'm making $300 a month. That's not your profit. You need to account for the full cost of owning the investment. Real estate can absolutely play a role in building wealth, but it's a business decision, not a guaranteed path to becoming rich. Now, the most important part, the account you hold them in. Now, here's where Canadian parents need to pay attention. Knowing what to invest in is only half of the equation. You also need to think about where you're holding these investments, because Canada gives us accounts like the TFSA, RRSP, and for parents, the RESP. These aren't investments themselves. They're account structures that can hold different investments. And that's an important distinction. You don't really invest in a TFSA. You open a TFSA and decide what investments to hold inside it, subject to applicable rules. The same concept applies to the RRSP and the RESP. And the account you choose can affect taxes, government grants, withdrawals, and ultimately how much of your investment return your family actually keeps. So, the final takeaway, here's the biggest lesson. There's no investment that's perfect for every dad. The right place for your money depends on why you're saving or investing, when you'll need the money, and how much risk your family can realistically handle. If you're a Canadian dad trying to make smarter decisions about money, investing, and raising a family, subscribe to Canadian Finance Dad, and I'll see you in the next one.